Joining us from Stamford, Connecticut to discuss all of this, Drew Matus, senior U.S. economist and managing director with UBS, right here in studio. Uri Landesman, Platinum Management President, and also Michael Guyette, our guest host from Pension Partners, is back with us. Welcome, gentlemen. Uri, beginning with you here. Are investors at some point going to react to this sugar high that they may get from the Fed, from central banks around the world? I mean, could that actually lead to a higher market right now?
I mean, it's possible, but pretty unlikely, and that sugar high wouldn't last very long. I don't think there's.
Is that because it's becoming diluted? Because people kind of expect it, and they're at the point where they're like, well, you know, I don't know if the Fed really can do that much if they keep doing these things.
Think about a fishing reel. We've been extending line out for about 6 years now. There's just only so much tackle left. And so there just isn't much left for them to do, frankly. You know, with the U.S. Treasuries, you know, long bond trading at a 1.6 yield, I mean, what else are they supposed to do? So I don't really think what's going to rally this market is Fed action, and probably the ECB doesn't have much more to do either.
You disagree with that?
No, actually, I don't. And it's funny, you know, I always call them super band in the League of Extraordinary Bankers. Everyone's talking about QE3. Yields are at all-time lows. QE3 is you and me. It's already underway through this fear trade. So now what if these low rates are not indicative of the economy, but are actually stimulative, at least for equities, in the sense that you don't actually need to have the Fed come in. The market is already doing it.
I wonder, Drew, what's your take? Because Sarah, as she was walking off set here, said, oh, you're going to get another optimist there from Drew. What do you expect as far as the Fed stepping in to help? Do you think central banks need to step in around the world? Do you think it's going to happen?
Well, I'll just say that your two other guests are the two smartest people I've heard in a long time, because, you know, there's this idea out there that the Fed's omnipotent, and they're not, and that they have unlimited firepower, and they don't. And Bernanke understands that better than most people. So, you know, are we expecting anything from the Fed? The answer is no, and it's for the reasons cited. It's already moved.
They've already moved. What about QE3, QE4, QE5? I mean,
well, there is no scope for QE4 or QE5. That's the problem. Right now, if you look at what they've held, what they've bought, the things that they've purchased, and you try to figure out where they would go next, quite frankly, there are legal limitations on the Fed, and they can't go around them. And Dodd-Frank actually further tightened up those legal limitations. So the Fed's more constrained than I think most people realize, and they get no points for going out there and reminding people that they are in fact constrained. So you do have these people out there believing QE4 is possible, but when you run the numbers in terms of what they can buy and how much they've already done, it doesn't really add up. Yeah,
you don't think it adds up. But you know, let me ask you, Michael Guyette, because you're the bull in this group. You still think the market can rally another 30% by year end. Isn't part of that rally going to be based on the thinking that the Fed can come and save us, that the ECB can come and save us all, that the central banks around the world will just print?
I think there's an element of that, but I think there's also the reality that the Fed's inflation target of 2% means that if you're a buy and hold investor in 10-year treasuries, you're taking a guaranteed loss in terms of your purchasing power. The difference between bonds and stocks is simple. Bonds, you have no chance of keeping up with purchasing power. Stocks, at least you have a chance, given the dividend yields are still rising.
So inflation.
I mean, I want to hear more about these legal restrictions on the Fed as far as QE3 and QE4. I haven't heard that much about that. I see you already shaking your head as Drew mentions that.
Well, I'm not so much. I mean, you know, the legal restrictions are what they are. It's just, you know, there's so many arrows in the quiver, and they've been firing them for a long time. And I think people are losing track of that. And there's only so much they can do. I mean, this turns around because business confidence turns around, because Europe does what it really has to do. What we're talking about here is Band-Aids, and the Band-Aid box is empty. And so it's going to have to be.
Maybe it's time for the tourniquet.
You know, it could be. Look, I mean,
sever the limb. You know, I mean, what do you think Europe really has to do? Speaking of tourniquets,
I mean, this is somewhat anti-growth, but they really have to. I don't know. I mean, for lack of a better term, the people have to start working. Okay, I mean, they have 35-hour work weeks there, maybe 8 weeks of holidays.
Right, but you're talking about changing an entire cultural landscape, and you know, George Soros is telling us we've only got 3 months to do it.
He'd rather have Germany just come in and bail out the rest of the continent.
Well, I think that's a terrible idea, and what should happen right now is, maybe it's going to get bad enough for them actually to change. But I promise you that any Band-Aid you put on like now, like Germany bailing everybody out, which they're not going to do, by the way, is only going to prevent disaster for a year or two at the most, and you're going to be right back here a couple of years from now.
But final word here from Drew before we let you go. What do you think Europe needs to do? If you were a central banker at the ECB right now, what is your prescription to fix this mess?
I mean, I would leave it to the government. So, I'm a central banker, so I'm a coward by nature, and I think I would just let things play out. I don't think the ECB has the ability to step in here. They don't have the same ability as the Fed even does, and it's not because of the constraints, it's because of the way the ECB was structured. So
this ends badly.
I think a lot of those structures would work to our benefit over here in terms of the limitations imposed on them.
Drew, you think this ends badly in Europe? I mean, if the ECB can't step in, they can't do anything. It's a contagion problem with bank runs galore in Europe?
Well, UBS, we expect Greece is still going to be in the Eurozone come the end of this. So it's probably not going to end well, but how badly is anyone's guess.